All right, let's dive into one of the most important score-defining topics for your exams, the financial statements of companies. We're not just going to go over the rules today. We're going to break down the exact traps that ICAI loves to set so you can see them coming and avoid them. Let's get right into it. Okay, let's kick things off with a classic ICAI problem. Just look at this scenario. A company has 230 lakhs in its reserves. That's all your securities premium, your capital reserve, the whole lot. But at the same time, it's carrying an accumulated loss of 250 lakhs. So when you net those out, you're left with a negative 20 lakhs. The big question, the one that can make or break your answer, is where in the world does this negative number actually go on the balance sheet? Now think really carefully. Your first instinct, and honestly the instinct of thousands of students, might be to just park this on the asset side. You might call it miscellaneous expenditure or something like that. And let me tell you, that is an instant fail. This is a fundamental error, a classic trap that ICAI sets to check if you really understand Schedule 3. Getting this right is what separates a pass from a fail. Okay, let's get right to it and tackle that first question head on. The answer to this lies entirely in the correct presentation as per Schedule 3 of the Companies Act 2013. So here it is, the one and only correct answer. Schedule 3 is absolutely clear on this. Any debit balance in your statement of profit and loss, which is just your accumulated loss, is shown as a negative figure under the head reserves and surplus. So you take your positive reserves of 230 lakhs, you subtract the P&L debit balance of 250 lakhs, and that final net negative 20 lakhs figure sits right there under reserves and surplus on the equity and liability side of the balance sheet, not the asset side. Period. This is it. Awesome. Now that we've cleared that up, let's take a quick step back and refresh some company law basics. Understanding what kind of company you're dealing with is the first step, because the rules can change a little depending on the type. Okay, let's do a quick fire round of the key company types you need to have at your fingertips. Limited by guarantee, liability is capped at a pre-agreed amount. Limited by shares, that's the most common one. Liability is limited to any unpaid share value. Government company, super simple. 51% or more is held by the government. Private company restricts share transfers and has a max of 200 members. An OPC, well, it's just one person. And a foreign company is one that's incorporated outside India but has a place of business here. Got it? Good. Let's keep moving. Now we're getting to the absolute bedrock of company accounting, Section 128. This section tells every single company how it must maintain its books of account. And this isn't a suggestion, it's the law. Section 128 really just boils down to 4 golden, non-negotiable rules. 1. Your books must always present a true and fair view. 2. You have to use the accrual basis, not the cash basis. 3. It must be the double entry system. That's the foundation of everything we do in accounting. And 4. The books have to be kept at the company's registered office, unless the board passes a resolution to keep them somewhere else. Now here's a number that is an absolute favorite for multiple choice questions. How long does a company have to keep its books of account? The answer is a minimum of 8 financial years immediately before the current year. Just burn this number into your brain, 8 years. Don't throw away an easy mark on this. Okay, huge exam alert on this one. This is a recent amendment, and you know how much ICAI loves to test those. If a company maintains its books electronically, the software it uses must have an audit trail feature. This basically creates a log of every single change made to the entries. And here's the real kicker they'll ask you about. That audit trail feature cannot be disabled. This is a massive deal for transparency and makes it way harder to manipulate the books. And hey, on top of the financial books, remember that companies also have to maintain several other statutory books. This isn't just about the numbers, it's about proper corporate governance. This includes stuff like the Register of Members, the Register of Charges on company assets, the minute books for meetings, a Register of Directors and key managerial personnel, and a register for any contracts where directors have an interest. It's a whole legal framework. So, we've talked about how to keep the books. Now, let's talk about the final product of all that hard work. What does Section 240 of the Companies Act actually consider a complete set of financial statements? So, according to the law, a complete set of financial statements isn't just a P&L and a balance sheet. It's a whole package deal of 5 things. You've got your balance sheet, showing the position at year end, your statement of P&L for the performance during the year, the cash flow statement, the statement of changes in equity if it's applicable, and then number 5, the one that students so often forget but is just as critical, the explanatory notes. The notes are an integral part of the financial statements. Don't ever forget them. Okay, now we get to the master template, the absolute rulebook for presentation, Schedule 3 of the Companies Act. You can't just make up your own format. You have to follow this schedule, line by line. Now, a point that often confuses people is that Schedule 3 has 3 different divisions, but it's actually super simple. Division 1 is for your regular companies that use the normal accounting standards. Division 2 is for the companies that have to use IND IS. And Division 3 is a special format also based on IND IS, but it's specifically for NBFCs. That's really it. Just know which one applies and you're all set. Let's look at 2 fantastic disclosure traps that I've seen trip up so many students. First up, bonus shares. Let's say a company discloses that it issued bonus shares, but it doesn't say where they came from. Is that a violation? The surprising answer is no. Schedule 3 only asks you to disclose the details of the allotment for the past 5 years, not the source. Now compare that with this. Can you show a provision for contingencies under the reserves and surplus head? Absolutely not. You have to remember the fundamental difference. A provision is a charge against profit for a known liability. A reserve is an appropriation of profit. They are completely different concepts, and mixing them up is a guaranteed way to lose marks. Next up, a classic problem on loan classification. So, a company takes a 10 lakh loan. The deal is it has to be repaid in 10 equal half-yearly installments of 1 lakh each. So, at the balance sheet date, how are you going to show this loan? Is the whole thing non-current? Is it all current? Or is it something in between? This is the perfect example of what we call current maturities of long-term debt. The rule is simple. Any portion of a long-term loan that's due within 12 months from the balance sheet date has to be classified as a current liability. In this case, 2 installments are due in the next year, so that 2 lakhs gets reclassified as a short-term borrowing under current liabilities. The other 8 lakhs, that stays as a long-term borrowing under non-current liabilities. You have to split it. You can't just dump the whole amount in one place. And this is a really hot topic that IKII has been focusing on a lot lately, the disclosure of trade receivables. What exactly does Schedule 3 demand that you show? The rules here are very, very specific, so listen up. First, you have to break down your receivables into 3 categories: secured good, unsecured good, and doubtful. Second, you must separately disclose your allowance for doubtful debts. Third, you have to show any amounts due from directors or related parties separately. And finally, the big one that is now absolutely mandatory, you must provide an aging schedule. And this is the exact format. This is not optional. You have to present this table showing the aging of your receivables in different time buckets, less than 6 months, 6 months to a year, and so on. And you have to provide this breakdown for 4 different categories: undisputed good debts, undisputed doubtful debts, disputed good debts, and disputed doubtful debts. You need to know this format by heart.
I've got a question for you. Just think about it for a second. You have a shareholder who's on the ball. They pay their call money way before it's even due. So the company has their cash. Now, when it's time to declare a dividend, does that shareholder get a dividend on the extra amount they paid in advance? The answer to this is a classic ICAI trap, the kind that costs you easy marks. We'll get to the answer in just a little bit.
So, imagine this. You're the accountant. The board of directors comes to you and says, listen, our profits this year, they're not great. We might even have a small loss. But look at our reserves. We have massive reserves built up over the years. We have to keep our shareholders happy, so we want to declare a dividend. Can we do it? Is it legal? Answering that exact question is the whole point of this chapter.
So, where can this profit money come from? The law is super specific and gives us exactly 4 options. Number 1, profits from the current financial year. 2, all those accumulated undistributed profits from past years. 3, a mix of both 1 and 2. Or 4, and this is pretty rare, money that the government provides specifically for a dividend guarantee. But please pay close attention to the little phrase in the brackets, after depreciation. This is the first hurdle. It's non-negotiable, and it's where a lot of mistakes happen.
And there's a massive but that comes with this rule. The law says you can't just dip into any old reserve you see on the balance sheet. Dividends can only, and I mean only, be paid out of what we call free reserves. So, your general reserve? Yeah, that's fair game. But things like a revaluation reserve, the one you create by just marking up the value of an asset, or a capital reserve? Absolutely not. Using those for dividends would basically be like giving capital back to shareholders, which is a big, big no-no.
I am giving this its own slide for a very good reason. This is a classic exam trap where marks just disappear. Before you even think about the dividend rate, you absolutely must provide for depreciation according to Schedule 2 of the Companies Act. And it's not just for this year. If you have any unprovided depreciation from past years, any arrears, that has to be cleared first too. Just think of it as a mandatory bill you have to pay before you can even start to see what profit is left to share.
So, the answer to the board's question is yes, you can use reserves, but, and trust me, it's a very big but, you have to pass a series of tests that are laid out in the company's rules. And this isn't an either-or kind of deal. You have to satisfy every single one of these conditions to legally declare a dividend out of past profits. No exceptions.
And here they are. Seriously, treat this slide like your exam checklist. First up, the rate check. Whatever rate of dividend you declare, it can't be higher than the average rate you declared in the last 3 years. Second, the amount check. The total cash you actually pull from your reserves can't be more than 10% of your paid-up capital plus your free reserves. Third, loss set-off. If you have a loss this year, the money you draw has to first be used to wipe out that loss. Only what's left over can be used for the dividend. And finally, the balance check. After you've taken the money out, the leftover balance in your reserves cannot drop below 15% of your paid-up share capital. Wait, there's one more. And honestly, a lot of students miss this point. Before you even start applying those 4 conditions, there's a master rule. The law says that no company can declare a dividend unless any carried over losses or unprovided depreciation from previous years are first set off against this year's profit. This happens before you even think about dipping into reserves. It's a crucial first step. You know, theory is great, but marks come from application. So let's move on to our first ICAI-style problem and see how these rules actually work in practice. This is where we put our little checklist to the test.
Okay, let's apply our checklist to this company XYZLT. They want to declare a 10% dividend. As you can see, we're going to check each condition one by one. First, the rate. Is 10% less than or equal to their 3-year average of 12%? Yes, it is. So check 1 is passed. Next, the amount we need to draw. The math shows we need to pull about 6.5 lakhs from reserves. Is this below the 10% cap of 12.25 lakhs? Yes, it is. Check 2, passed. And finally, the balance check. After we pull the money out, will the reserves stay above the required minimum of about 14.6 lakhs? Well, the math shows it'll be over 18 lakhs, so check 3, passed. Since all conditions are met, the board's plan is totally valid.
Now let's talk about a classic ICAI twist. The rules we just went through, they apply to the final dividend. But what if a company is currently making a loss and wants to declare an interim dividend right now, during the year? For this very specific situation, there's a single, simple rule to remember. The rate of this interim dividend just cannot be higher than the average dividend rate of the 3 financial years that just passed. It's a simple exception, but a very important one to keep in your back pocket. So far, we've been talking about dividends pretty broadly, but what happens when you have different kinds of shares? The rules can be a little different for preference shares, for partly paid shares, and yes, for those shares where calls have been paid in advance. It's time to solve our opening puzzle.
This slide is absolutely crucial. First, preference shareholders. As the name suggests, they get preference. They get their fixed-rate dividend before a single rupee is paid to the equity shareholders. They're first in line. Second, partly paid shares. Let's say a share is worth 10 rupees, but only 5 rupees has been paid up. Well, the dividend is generally paid only on that paid-up amount of 5, as long as the company's articles of association say it's okay. And finally, here it is, the answer to our opening question. Calls in advance do not rank for a dividend. That advance payment is legally treated as a loan to the company, not as part of its capital, so no dividend is paid on it. That is a key takeaway.
All right, let's switch gears from calculation to compliance. What happens after a dividend is declared, but some shareholders just don't claim it? The company can't just keep the money. The law lays out a very strict timeline and a procedure for handling this unpaid dividend, and it's a timeline you absolutely cannot ignore.
So let's walk through this journey. It all starts on day 0, the day the dividend is declared. Shareholders have 30 days to claim their money. Once that window closes, any money that's still unclaimed has to be moved within 7 days to a special bank account called the Unpaid Dividend Account, or UDA. Then, the company has to publish a list of these shareholders. Now, if that money just sits in the UDA unclaimed for 7 continuous years, it's finally transferred to a government fund called the Investor Education and Protection Fund, or IEPF.
Now, what if the company messes up? What if they don't transfer the money to that unpaid dividend account on time? Well, the penalty is pretty steep. The company has to pay interest on the amount they failed to transfer at a rate of 12% per year. And that interest actually goes to the benefit of the members. So yeah, the regulator does not take this deadline lightly at all. And this brings us to the final step in the journey. After 7 years, the money goes to the IEPF. But here is the most crucial point, and it's a detail that is so often missed in exams. It is not just the dividend money that gets transferred. The actual shares on which that dividend was supposed to be paid are also transferred out of the shareholder's name and into the name of the IEPF. This is a massive consequence, and as you can imagine, failing to comply with any of this results in some pretty heavy fines for both the company and the officers in charge.
Okay, let's put everything we've learned together now and tackle a full-blown final accounts problem from the source material. We've got the trial balance of Omega Limited and a whole bunch of adjustments. This is exactly the kind of thing you're going to see in the exam hall.
When you get a big problem like this, the key is to deconstruct it, one adjustment at a time. First, we've got a suspense account. Turns out it's a profit on the sale of a machine, so that's going to go under other income in our P&L. Simple. Next, depreciation. We have to be really careful here to only calculate it on the machinery we still have at the end of the year. Then, the dividends. The interim dividend that's already been paid is an appropriation of profit, so we show it being taken out of our reserves. The proposed final dividend, though, that's just a note for now. Finally, the land revaluation. This creates a revaluation reserve. And as we learned, that is not a free reserve, so we cannot touch it for dividends.
Haria Chemicals. We're not going to solve the whole thing from scratch, but we're going to use it to reinforce one final, absolutely critical concept that really connects everything we've just done.
So, you've done all the hard work, you've prepared the entire statement of profit and loss, you've arrived at that final number, profit for the period. Now what? Where does that number go? The crucial thing to remember is that it doesn't just disappear. If you look at the reserves and surplus note in the Haria Chemicals solution, you'll see the whole journey. You start with the opening balance of the P&L. You add this year's profit for the period, and you get the closing balance, which then appears right on the face of the balance sheet. This flow from the bottom of your P&L through the notes to accounts and onto the balance sheet is the fundamental link between the two statements.
All right, picture this. A company wraps up its financial year on March 31st. A couple of days later, on April 2nd, the board declares a dividend. So the big question is, and this is where a lot of people get tripped up, do you show that dividend as a liability on the March 31st balance sheet? Have a think about it. We're going to circle back to this, and I promise by the end of this session, you'll know the answer inside and out. And look, I'm not kidding when I say this is a classic ICAI trap. A huge number of students get this wrong every single time. But don't you worry. Today, our mission is to make sure you are firmly in that top 10% who see this coming and know exactly what to do.
Okay, enough talk. Let's get our hands dirty. Honestly, the absolute best way to learn this chapter is to just do a full exam-style problem from beginning to end. So that's exactly what we're going to do.
Here we go. A little piece of the trial balance for a company called Delta Limited. You've got your usual suspects, share capital, debentures, some assets. But when you look at a trial balance like this in an exam, your eyes should immediately scan for anything weird. And there it is. See it? That suspense account, sitting there with a credit balance of $10,000. That is a massive red flag. It's basically the exam paper screaming at you, hey, there's a story here you need to figure out. And, of course, with any good exam problem come the adjustments. And these are really the heart of the whole thing. We've got a land revaluation, we finally find out what that suspense account is all about, and then there are some very specific disclosure requirements for our bank balance and receivables. To top it off, we've got depreciation and tax. This is prime material for ICAI to test if you're just a number cruncher or if you actually understand the underlying concepts. All right, let's start putting this puzzle together. First up, the statement of profit and loss. The secret here is to be methodical. You follow the Schedule 3 format, and you build it by preparing your notes to accounts first. So let's go one note at a time. So that's suspense account. Let's crack it open. The adjustment says the 10,000 rupees is cash from selling a piece of machinery. So let's do the math. The machine originally cost 24,000. We'd already depreciated it by 20,000. So its book value, or what it was worth on our books, was just 4,000. We sold it for 10,000. Simple math, 10,000 minus 4,000 means we made a profit of 6,000 rupees. And that 6,000? That's our first item, other income, a super critical adjustment to get right. Okay, now for some of the, let's call them easy wins. These are the straightforward expenses. Finance costs? That's just the 12% interest on our $250,000 of debentures, which comes to 30,000. Then for other expenses, we just need to group together the different expenses given in the trial balance: factory, selling, and admin. These are easy marks, as long as you remember to present them neatly in the notes. Okay, now pay close attention. We're talking about depreciation, and trust me, this is a classic ICIA trap where so many marks get lost. The question says to provide depreciation at 10% on cost. The opening cost of all our plant and machinery was 7 lakhs, so the depreciation is simply 10% of 7 lakhs, which is 70,000. You see the twist? Even though we sold a machine, the instruction is very clear. Calculate it on the cost of the assets. A lot of students would mistakenly calculate it on the written down value or the closing balance. Read the question carefully. It makes all the difference. So after all that work on the notes, let's see how it all stacks up in the actual P&L statement. We start with our revenue, add that 6,000 of other income we calculated from the sale. Then we subtract all our expenses, the finance costs, the depreciation we just calculated, and all the other expenses combined. That brings us to a profit before tax of 156,000. We hit that with a 30% tax provision, and we land on our final profit after tax, 1,099,200. This number right here is the golden link between our P&L and the balance sheet. P&L, done and dusted. Now for the moment of truth, the balance sheet. This is where we see if everything we've done actually works, and if we can get those two magic totals to match. Let's get it to tally. First up, let's talk about share capital. And listen, when it comes to the disclosure here, Schedule 3 is the law. It's totally non-negotiable. You have to show authorized, issued, and subscribed capital. And within subscribed capital, you must show the split between fully paid and not fully paid. The most important exam point here is calls and arrears. If the company has called for money but some shareholders haven't paid up yet, you have to show that as a deduction to get to the correct final paid-up capital figure. All right, next up is the reserves and surplus notes, and believe me, this is where a ton of the action happens in a problem like this. First, remember our land was revalued? It went up from 3 lakhs to 9.6 lakhs. That increase of 6.6 lakhs creates a brand new reserve called the revaluation reserve. This is super important. Then we bring in our profit. We'd start with any opening P&L balance, add the 109,200 profit we just calculated for the year, and then subtract any money we've taken out, like for dividends. And now for the main event, really, the PPE schedule. This note is huge because it pulls together so many of our adjustments into one place. Let's break it down. For land, it's simple. The new value is 960,000. For plant and machinery, look closely. We started with a gross block of 7 lakhs. We sold a machine that cost 24,000, so we subtract that, leaving a closing gross block of 676,000. Then for accumulated depreciation, we started with 3 lakhs. We have to remove the 20,000 of depreciation attached to the machine we sold, but then we add this year's depreciation of 70,000. That gives us our final net block. It's complex, but it's logical. Okay, let's not forget the smaller details because these are where you pick up those extra crucial marks. I'm talking about disclosures for trade receivables and cash. For receivables, the law says you have to give an aging schedule. The adjustment told us 50,000 was outstanding for more than 6 months, so we have to show that separately. Same idea for cash and bank balances. The adjustment said 5,000 was with a non-scheduled bank. You must show that split. These are easy marks if you just remember the rules. So we've talked about liabilities. But what about something that could become a liability, but isn't one yet? Well, that, my friends, is a contingent liability. It's a potential obligation that hinges on some future event. A perfect example is if you own partly paid shares in another company, you might be called upon to pay the rest later. And the most crucial thing to remember, this does not go inside the balance sheet. It's not part of the total. You always disclose it as a simple footnote at the very end. All right, we've gone deep on the big problem. Time to switch gears a bit. Let's do a quick rapid-fire revision to make sure these key concepts are locked in your brain. Ready? Okay, first one. Imagine this. A company has a long-term loan, but one chunk of it has to be paid back within the next year. Where do you classify that specific piece? Is it A, B, C, or D? And the answer is B, short-term borrowings. Now here's the exam tip. You might be tempted to just say current liabilities, right? Because technically it is. But ICII wants precision. The exact subhead is short-term borrowings. That's the difference between full marks and 0. They test if you know the exact classification. Okay, next question. A company's IPO is oversubscribed. They've got a pile of cash from share applications that's more than the shares they actually issued. Where does that extra cash go on the balance sheet? Simple. It goes under other current liabilities. And the logic is solid. It's not the company's money to keep. They have a legal obligation to refund that excess money, and they have to do it soon, which makes it a current liability. All right, we've been deep in the weeds with calculations and formats. Let's pull back for the final checkmate. The big picture principles that tie everything together and ensure your final accounts give a true and fair view. So let's boil it all down. If you remember nothing else, remember these 5 things. 1. The ultimate goal is a true and fair view. Your numbers must reflect reality. 2. Schedule 3 is your rulebook. It's non-negotiable. Follow the format exactly. 3. And this brings us back to the question I asked at the very beginning. That dividend declared on April 2nd, it is not a liability on the March 31st balance sheet. Why? Because on March 31st, no legal obligation existed. It's an event that happened after the reporting date, so you just disclose it in the notes. 4. Be a detective. When you see something like a suspense account, it's a red flag telling you to investigate. And finally, 5. Always read the adjustments first. They are the roadmap that will guide you through the entire problem. Nail these points and you are going to be in fantastic shape.